I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go Eslim.
Hi, I'm Steve Miller. Call me Slim. And this is the Eslim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward to what might happen in coming weeks, and hopefully lots of great ideas and opportunities for you throughout the show. Well, the stock market moved lower early in the last week as investors anticipated very hot inflation numbers. It was kind of sell the rumor, buy the news, as these historic numbers did not really bring any big selling. So when that happened, buyers came in, as diehard bulls just don't want to miss the next move to new highs. Good luck with that. Monday saw a decline very early as China dropped 3% as their PPI surged, suggesting that they may do less stimulus despite the fact that they are in the middle of some very big lockdowns with nearly 30 million people locked down. And at the same time, U.S. interest rates, they moved up again, hitting nearly 2.8% and then making it up to that level later in the week. On Tuesday, stocks moved down early again. There was some huge selling in Germany and the German banks. That had the markets a bit shaken up. But then they reversed when the CPI came out, and they had shown that month over month it was up 1.2%, year over year 8.5%. Investors had hoped that the worst was out. S&P's down overnight some 27%, 27 points, fell on that news of that selling in Germany, but then began to rally back, made it to up 60, but then sold off all the rest of the day after a first-hour high, closing with a small loss. Again, afraid of what the PPI was going to bring. Wednesday, PPI, well, no disappointment. Well, maybe no disappointment to bears. PPI up 1.4%, year over year 11.2%. These are the biggest numbers seen in over 40 years. Got to go back to about 1980. We'll talk a little bit more about that in a moment. Still, buyers are ready to step in, and when that news came out, since the market didn't sell off, S&Ps rallied, and they got to up 50 to end the day, despite the fact that JP Morgan came out with pretty poor earnings. Thursday, here today, in this holiday-shortened week, the market starts out looking at some news that Elon Musk wants to buy Twitter for $54.2 a share. The stock jumped up 13% immediately, but then when everybody got a look at the details of it, the stock started to sell off again and actually gave up all of those gains. It turned out that Musk said best and final offer if he can get financing, and there was lots of way outs for him on the deal, and nobody really believes it's going to happen. So Twitter, which had that big pop, gave it all back. In the meantime, earnings from the banks continue to be disappointing. Wells Fargo sells off as their revenue misses, and that pretty much forming a trend on bank earnings. Citigroup, their earnings, their profits were down 46% year over year, just a crazy big drop. And that was because investment banking is really slowing down. But the stock, did okay on that news, kind of expected bad news. Goldman Sachs came out. Their earnings were a little bit better than the rest of the group. They rallied and then sold off also. So there are sellers waiting there in the financials. And Arvi did some work over the week and shared that and showing that the financials had some risk here. The ECB news came out finally. They held their policy meeting and they held their policy. No change. They're going to continue their asset purchases. Could you believe that in this environment with inflation absolutely roaring? I mean, if this is proof, if you ask me, that Christine Lagarde is completely incompetent. Couldn't stand her when she was in the IMF, and I think she's just horrible for the EC, for the European Union right now. Stocks down at midday here in the S&P 500 about 25 points. But on the S&Ps, but the Nasdaq much worse, so down about 1.4%, as interest rates then creep up today to about 2.8%, a new high for this cycle. And when the traders see that, investors see that, they know that that's costly to the techs that borrow a lot of money, and the techs get sold, and that's what's happening right now with Apple, Nvidia, those stocks leading the way on the downside. So with huge focus on inflation and interest rates, and how this feckless Fed tries to correct their policy error, yes, I want to tell you that, Russia-Ukraine war did not cause this, as much as you hear that coming out from the present administration. It was caused by the Fed and by the government throwing money everywhere, and got a little kick, of course, when the war started. I spent some time with a new tool that was brought out by my friend, Tim Knight, from Slope of Hope. Of course, Tim and I both, Tim still does a show on Tasty Trade, a great show. And I, of course, started out my media life in Tasty Trade. And those are still my buddies, and I owe them a lot for teaching me about doing what I'm doing right now regarding the media aspect of it. And I consider to be Tim a friend and a technical analyst brother. So we chat now and then, and he came out with a new tool, and I thought it was really interesting, and I want to share that with you because of all this discussion about inflation and interest rates. And I thought you'd find this really interesting. Here is the Slope of Hope website that I'm at right now, and this is his new yield curve tool, which is really great. You can see all that's available here on his site. Just a great combination of social media and charting, of course, and lots of other stuff that's on there. And he just released that this yield curve tool, which is at the bottom of this chart list that you see right over there. And I thought you'd find it just crazy interesting when I look at this. So right now, this is set to as far back as it goes. That's 1981 right there. And I thought you'd be interested to see that the yield curve, what it looked like, as of course Volcker was squeezing the inflation rate out of the economy, and talk about an inverted yield curve. If you look here at the 6 month, this was up here at 17.17%, and way out here to the 30-year, this was down here at 14.7%. So talk about squeezing out inflation. Now, remember, the inflation rate back then was only slightly more than what's going on right now. And it started to come back down within about 2 or 3 years. It was down under 6%. So it was working, and maybe part of that was natural. But I want you to see going forward what yield curve inversions really look like. And this is just a great tool to do that. So let's come all the way up here, and we're going to scroll forward, as you can see, as I go through the years and go through the decades. And we're going to come up here to 1999. Now, as we move here through the 90s, you can see this very steep yield curve is what fed the bubble, the dot-com bubble that came and eventually burst. And you can see in here as all of a sudden you began to get a little blip in the yield curve here in 1998 as the dot-com bubble was really developing. And then all of a sudden you got this double hump there here in 2000. And then when the Fed wanted to burst the bubble, as you can see right over here, here in 2000, you have rates up here at 636, basically on the 3 month, the 6 months. Down over here, the 10-year is a 569, so this is about 3/4 of a point inverted there, and then this kind of hump that you see at that point. So they accomplished what they wanted. They burst the bubble, and of course the bubble that they were responsible for, and we ended up with a big recession, and the stock market, of course, losing half its value, and the Nasdaq losing 80% of its value. So they engineered all of this, and you can thank them for those people that write to me that said how much money they lost at this time. Of course, when the inflation hit, when the recession hit, and all of a sudden they wanted to get the market to be in better shape, make us all feel more wealthy, and get us to borrow more money, they brought rates way down over here. So you can see this steep yield curve that goes all the way from 1.75% all the way up here to 5.75%. So that's a 4% steepness in the yield curve. And as we go out here to 2002, 2003, they're blowing up the great financial crisis. They're blowing up the bubble that caused the great financial crisis. 2005, you could see a slight little inversion going on. This almost looks like the yield curve right now. When you look at the 20s above the 30s, this is very close to that. And I'll show you that when we get further down. And then, of course, they invert the yield curve in 2006, 2007, and you get the great financial crisis. The crisis that they created like this and caused all the free money plus all of the other stuff in real estate that that they stood by and the government made happen essentially through their affordable housing plan. And then, of course, it all burst after this inversion. And in 2007, it began to move back. 2008 was the beginning of the great experiment. And the steepness of the yield curve as I go through 2008, 9, 10, 11, 12, 13, 14, 15, 16. You got a little humps and stuff going on in 18 and 19 when they were trying to get some normalization. It couldn't really happen as you got through that period, and all of a sudden the steep yield curve again. And then we got hit by the pandemic here in 2020. It gets even steeper. But you could see yields way out here on the long end. They're still under 2%, and here they're down here near zero. So this is the steep yield curve and historic low interest rates. And now as I come out over here to 2022, this is that little hump right over here where the 20s above 30s. You talk about the news saying, oh, we have an inverted yield curve. And yes, you got some flatness between the 5-year and the 10-year, but big deal. This is not what cures the inflation that we have right now. You've got to go back to the steep yield curves. This has to get above here. So if we're going to be at a 3% yield, that means that the near end here has to go to probably 3.5%, 4%. That's going to take out till 2025 to get it out there based on the rate that they're talking about. So they're giving you a bunch of bull when they talk about the steep yield curve and everything the Fed is doing. The Fed has a ton more to do, and this yield curve is going to have to get inverted in a real way in order to deal with the inflation rate that we have right now. This is such a cool tool, and it allowed me to go through everything that I just wanted to for you to see. I'm going to go back over here to the Volcker time, 1981, and I'm going to animate this. I'm just going to play it right there, and you can play it fast or slow, and you can see it going through all of the years right there as it's animated on its own, and this is just great. I want to thank Tim Knight for sharing this with me and allowing me to use this tool to really look at what happened back over these 40 years. Just absolutely great tool. And so thanks, Tim, for that. And I really liked using it and having an opportunity to show it off. Great work. And you always, of course, do great work. Tim Knight, my good buddy, and a great tool, as you can see. So what that's going to mean probably as you look at the potential for a much more steeply inverted yield curve, in fact, a real inverted yield curve, that's going to be rough for stocks. I mean, it always is, and the banks are starting to suffer now. And right now, with a much more inverted yield curve coming, the banks are going to have a rough time for a very long period of time. That means that the stock market is going to have a very rough period of time going out. I've been saying, and you better get used to it, because I think that the rallies that we get in the market that you see are just opportunities. If you're an investor and have not lowered your allocations, you really have to consider that. And I think that this illustration really gives you a good sense for the fact that, if the Fed is starting to change their policy, they're just starting. They might back off or slow down when there are signs of recession or that there's some back off in inflation. But don't look for a lot of that. They have completely lost credibility. They need to try to fix the damage that they have done. And the rest of the world has to get on board with that. The Bank of Japan has They haven't blinked yet, and they're a bunch of idiots over there. And of course, you got Christine Lagarde that refuses to do anything, and all of that may be in regard to the fact that they're worried about the energy squeeze that could come out of this war. But there is a lot of trouble out there. I think that you might get on board with that. It just makes sense to lower your risk if you haven't done that yet. For the week, this shortened week, as here we are on Thursday, and we only do the Thursday shows when Friday is closed. S&P 500, the NASDAQ, they're down over 1%, closer to 2% for the NASDAQ. Dow Jones just edging slightly lower in here, and they're also up almost 1%. So kind of a mixed market when you look at that. Bond market, 30s are up over a point right now on the week. The 10-year yields now at the highs for the week. Trading right around the 2.9%. So continuing to pop up. The 30-year yields now down about 2 points on the day, so it's getting worse. Maybe they're down 1.5 for the week, and the 10 years now up about 9 basis points, trading on the high of the week. Gold market and silver market, they put on another rally. Gold's up over $20 on the week at this point. Silver market very strong, up about 70 cents, but still comes up to resistance and begins to back off. We continue to talk about it in future speak about the timing for what I think is a big upside move in the metals market, so you're going to want to watch that. The dollar up about 0.5%, really about a safety bid, and these other central banks that just refuse to take the medicine. Well, if they don't take the medicine, the market's going to make them. I mean, it's just that simple. And their economies are dying, essentially. And through the inflation and through a slowdown, you're going to get into one of the worst environments ever. And they're going to have to go through some battle about if they need to cure the inflation or not. Japan's going to have massive inflation with the difference in the currency valuation between the U.S. and the rest of the world as their goods become so cheap. So they're going to have to really look at that. Oil market up about $5 on the week as it gets a rebound, selling off now, so maybe up more like around 4. And that's been a rebound after the big selling, and we think there is room on the upside for the oil market, but modestly, not anything really big. If you want to learn all about our futures analysis, of course, which is our multiple time frame cycle analysis, you can just become a level 2, 3, or 4 member. Just write to Matt, Matt at askSlim.com, mention futures, and ask him for the deal that gives you that really unbelievable low price to watch that video and have everything in level 2. If you just want to subscribe to level 2, just go to the Eslim website. You can see what's in there. Write to Matt at askSlim.com and mention futures, and he'll send you those specials. Coming up in this shorter video, because of the holiday, I'm going to bring you 33 futures in 3 minutes with sharing the Eslim Market Monitor. What a great way to be able to see the whole market, 7 different sectors, in just a few minutes. And I'm going to give you my S&P 500 intermediate term analysis and give you a little cycle analysis lesson in there, because so many people are learning cycle analysis. And I'll tell you about how you can learn cycle analysis in just a few minutes also. I want to remind you, please do go to our website, askSlim.com, and explore it. Look around there, subscribe, share it with other people. If you're new, you could become a free member and just get notified when we put out this show and a few other free things, or do become a premium member. On YouTube, do subscribe to our channel, click that notification bell, and like this video. And then that really helps us. On Twitter, follow us at askSlim. And for any information on our memberships, our huge offerings of education and analysis, write to Matt at askSlim.com. All right, here comes analysis of 7 future sectors in just 3 minutes. I'm going to, if you haven't seen this at all, I'm going to introduce you to the Eslim Market Monitor, which essentially has our amazing suite of proprietary studies on there that you can just see in a glance. And we love that in a glance statement. that I think you're going to, and I think you'll find it very interesting. So we're going to move over to the Market Monitor right now, and I'll just bring that up for you here. So what we have here is a look at our Market Monitor. There are 4 studies on here, and they're listed in order of sensitivity. This is the Market Condition Indicator, the MCI. This is the Option Bias Indicator right there. This is the askSlim Slim Ribbon. And this is the Reversal Scout. So the Reversal Scout is the most sensitive of them all. And this gives us a great overview of the conditions of the market. For instance, the askSlim MCI, it goes from minus 100 to plus 100. You can see in here, as you look at the bond market, it's at minus 93. When it's in the area of minus 25 to plus 25, it gets up into a testing zone. But the colors in here really give you a sense for the longer term view, because this has longer term analysis built into it. So in other words, if it's really negative, and then as you see here in the 2-year, but then you get a pop-up in the short term here on the Reversal Scout, you know that there's a pretty good chance it's going to be moving down again. So here we have look at these top 4 right over here. These are the stock indexes. They are weak on the longer term. They tried to rally. They got a little bit neutral in here or positive, but then they gave that up. The Slim Ribbon is either neutral or negative, and the Reversal Scout is negative. And when these start to make a bottom in here, these are going to be turning green first. And then you'll know that. So that's what you have in the stock market. The bond market that you have right over here is all negative almost all the way across, except for the 2 years that have a little blip on the upside. So you get a sense for that. The option bias indicator tells you if you had an option position on, what direction you'd want to bias it right there. The Slim Ribbon shows you as a momentum indicator in here where the momentum is. And then this more sensitive directional indicator is the Reversal Scout, which is basically negative. Here's gold, silver, platinum, and copper. Next, you can see in here, these are 74 readings. There's some good long-term strength in here, and some powerful look right in here. Now I'm looking for a correction. I think these will turn red again, and they'll get a little bit weaker, but you could see there is a lot of strength. Of course, platinum is the weakest, and that shows you it there very clearly. And copper then we think is strong, going through some correction right over here, but if you watch Future Speak, you'll see we're looking for it on the upside. Here are the energies right in here. You can see that long term they're looking pretty strong. When you see that is built into the market condition indicator. Kind of neutral and mixed right in here, and then going through some corrections that you can see right there. Natural gas, some of these are not loading right now. I'm not sure the issue, but this is green. This right over here is orange. So that tells you it's overdone on the upside. And look for a short-term correction, because you've had these very powerful short-term moves. Look for a little correction, but overall, the natural gas market is very strong. Here's your greens right in here. Long-term, they look very strong. And through all of these indicators, all very much on the plus side. Takes you all the way down through soybean meal, soybean oil, have all of that in there. The coffee market is giving you some negative long-term readings. It's trying to rally in here, but it's not really in the best of shape. And here's the dollar and the foreign currencies right there. The dollar, of course, very strong as it moves up over par. And here's what the foreign currencies look like in here. They all look pretty weak. The Aussie is a little bit better than the rest of them, but still overall, these are going to have to turn green before you get any sense that dollar weakness is starting to come in. Here's your, right over here is some more of those foreign currencies, as you see. And here is Bitcoin and Ethereum. The longer term stuff is not coming in yet on that. And here you can see that for the short term in here, they're neutral to negative in Bitcoin and Ethereum. That is a look at the market monitor. You can see how amazing that is, and it really gives you such a great sense for how to direction your positions looking at that. You can use that and then apply your own work to it and see. That is available only to our level 4 and level 4 plus members. So if you're an Eslim member and you want that, please upgrade. You'd have to have a Thinkorswim account, so you'd open up a TDA account. Please do that through our website. Up on the front page, you just scroll over on the carousel. and click on that page and open up an account at TD Ameritrade, and that will help us, of course. So this is a great market monitor. I don't know of anything else like that out there, and of course you can have it level 4 plus members. All right, we're going to give you stock market analysis, but first, our cycle analysis workshop, the deal is expiring, and I want to tell you about that. Here we are now in the final 3 days of this. This ends on Monday, 4/18. We've been offering this for the last couple of weeks. We've had a ton of people invest in this. There's, in my opinion, no better way to understand the markets, the mechanics of the markets, than understanding this style of analysis. You can learn my analysis, which I developed over the last 47 years. This workshop, which is 21 video modules plus many tools for text videos, took me over 2 years to write and 6 months to produce. This is online, a lifetime access. As long as you're an askSlim member, as long as you are even a free member, and have access to our website, you have access to this workshop. You can watch it as many times as you want. You can take as long as you want, and you don't have to have any special platform. So it's all there for you, all of these teachings. You're going to never look at charts the same as you did before when you take this workshop. It's going to make everything very different for you. It will improve your directional decisions as we learn to project in time and price. There's so few ways to look at the market that let you project out in time, and I'm going to show you that in a moment when we look at the if you go and look at the analysis that I'm about to do on the SPY, the S&P 500. On May 10th, we're going to have a live event. Everybody who subscribes is going to be able to attend that event. And you'll be able to ask questions. We'll be making presentations. Matt has a demo reel if you want to see a few clips from most of the videos, and you'll get some sense about it. You can write him for that. This is a $400 discount that ends on Monday, 4/18. If you become a premium member, or if you already are, at any level 1, 2, 3, and 4, you save an extra $100. So if you're not a premium member, please do become one. You'll only pay $7.97 for this, and other workshops that have anything near this are thousands and thousands of dollars. And of course, they're nothing like the cycle workshop that we have. You can write to Matt at askSlim.com for info or for that special link, Matt at askSlim.com. Only 3 days left to go till Monday. It goes up to back to the regular price of $1,297, which still is a deal. So after Monday, you won't be able to get this special until we run it again, and maybe towards the end of the year or the beginning of next year. So that's it for the Cycle Analysis Workshop special, and thanks for listening to that. All right, this is the stock market, the SPY intermediate view. So when I say intermediate view, it means I'm looking at weekly charts. And generally that's 1 to 3 months that we're looking at, but this is going to take a little longer view than that as we look at the S&P 500. And I'm going to look at it in some different ways. So let's switch over now to the SPY. This is the market monitor. I'm just going to remove that out of here and then take you to the SPY. So this is the stock market, SPY, S&P 500. Many people look at it, with a candlestick chart. People tend to draw lines and trend lines on it. But what's on here is our moving averages that we look at on a weekly chart, which are the 13 and 34 SMA, simple moving average. And the 13, which you can see right over here, often gives you some support in the market or resistance, as you see right here. And our reversal scout really is a reflection of momentum conditions and also helps us with our cycle analysis. And you can see the reversal scout turned negative momentum right over here in January, and then gave that big decline right there. Now I'm going to begin to bring in the cycle analysis. I'll show you 2 more versions of this that you can see. So I'm going to go to this chart right over here, and all of a sudden you are seeing us bring in the cycle analysis. So cycle analysis looks at money flows, essentially. that's made up of large dominant cycles and minor cycles in there. You can see this big dominant cycle here and the harmonics with the minor thirds, like music. And you can see the minor 1/3, 2/3, and the third right in there that made that up. This one did the same, 1/3, 2/3, and the third. And when you get down into these areas here where there's a nesting is where these yellow zones are, as you could see on the bottom, which brings you the biggest of the corrections, as you see right in here. So we had projected a bottom right in here, and that was after a 14.4% drop in the SPY. And that we felt it would be rallying up and probably rallying out into late spring. So we had this big sharp rally and then a pullback right in here. This pullback is far away from this low, and this isn't necessarily a negative occurrence, even though the market's selling off here pretty much today, and with the S&Ps now down about 33 points, 3.3 here on the SPY. This is not down all that far. And then we were projecting up here and then some bigger trouble here. But I want you to have a better understanding of how the how not only in the S&P 500, but any way you would use this style of analysis could really help you understand market conditions. And I'm going to go here where I look at this analysis where I'm bringing in actually the projections and what really happened. So when we look at the cycle brackets on the bottom, they essentially are the ideal, as if it went up half the time and down half the time. But that doesn't happen. Actually, this went up about 90% of the time and only fell 10 or 15% of the time. So that is what's called a bullish configuration right in there. And you can see each of these minor cycles, as they're shown right in here, living inside the more dominant cycle, we're making higher highs and higher lows. And that's a bullish condition, and that gets you to keep moving on the upside. Here we're bringing in the stuff off the daily charts, which takes you even the smaller cycle inside of the minor cycles on here, inside of the dominant cycle here. This is where that cycle was bottoming. That's what it looked like as that low came. So where are we right now? Well, this is the next projection. Why is this projecting below this level here? It's because this was a negatively configured cycle. It is lower than where it started. The probabilities are high that the next rally will not achieve the level of the previous one. That means that that area up there at about 480 is not likely to get taken out. Right over here, the 78.6% at 465 would be about the best area that we would expect it to go up to. And this high up here got up to about 462, and then it began to back off. But you can see in here that this really looks like it has the opportunity to keep trying to get up over here all the way out into late May or early June. So we don't expect the big selling that we have in the market to be able to continue. It is more likely that it'll find support somewhere right in here and then begin to move up again after that. So our shorter term analysis has the supports in here. I don't have it on the weekly chart, but we're getting into this having come down about halfway from this rally, and somewhere in here soon it's likely to get a footing and then begin to move up again, or try to, and in what should be a choppy time frame. Then here, this is out in May or out into early June, where it tries one more time up here, depending on how deep of a sell-off this gets. And then you get into this very risky time, that next yellow corrective zone, which likely takes you down quite a bit of a way in here as the next big sell-off comes. The timing for this next cycle trough is September to November. That's way out over here, which should have some very large selling. The ideal versus the projected cycle is what you're looking at in here, because this is the ideal cycle right there, but the projected cycle is where, you know, from basically this distance here to right over here, which is 480 down to about 411 right there, should be pretty similar or worse on the downside, where you lose from whatever peak you have here about 80 points. That probably takes you down to 380 or lower from there in the S&P 500. So normally I do this only a 1 to 3 month view, but because I wanted to show you how this cycle analysis works, I took it out a little further. You see this green note right over there. The period of upside rebound may be a test of the high. It's doubtful. but we believe it's a false rebound, and this is a hook to make people believe that the bull market is alive and that it's likely to move up to new highs. I think the probabilities of that are very, very small. I would make it that the amount of percent that you could get above the high we just made over here is something like 1 to 2%. The declining possibility is between 20 and 30%. That would probably give you at least a 15 to 1 or maybe 30 to 1 risk reward on the downside. You see where the 15% correction is here. Here's the 20% correction, and the major 38.2% fib here under around the 380 level. That's really where we think it's going. Remember, this is the formations that we're looking at. That's not the price. This is where it shows up in the price right over here. And you can get a lot of chop in this period right over here, but then the risks really pick up in the summer and into the fall potentially, where you can get some big drops. This period here into May is a period that can fall hard. This period right over here into July is a period that could fall hard also. And then this one out to September through November. All of those. There are a lot of windows for large declines here in the summer and in the fall, especially. So basically intermediate view is a lot of chop in here, potentially try to get up to those highs around 462 again, up to about 465, and ultimately a very large sell-off and a continuation of the bear market that we have seen here. That is the S&P 500 cycle analysis, taking you through the stages. And I hope you learned something. Remember, if you take our cycle analysis workshop that has only 3 days to go, you will learn so much in the 21 modules. So I want to remind you, only through Monday the 18th can you save not only $400, but $500 if you remember or become one at any level. So I wanted to remind you about that. I hope you found this show to be unbelievably fascinating and valuable to your trading because, of course, your success is our success. Please go to askSlim.com and explore that site. If you're new, please become a member on YouTube. Subscribe to the channel. Click that notification bell so that you know when we put things out. And give us a thumbs up on this video. And do watch some of the member videos in our playlists and past shows that we have posted. Twitter, follow us at askSlim. And for information on our memberships, a huge offering of education and analysis, write to Matt at askSlim.com. That's it for this week. I want to wish you a happy Easter, those of you that do celebrate it. I want you to be so careful. It is so crazy out there. And I'm always wishing you great trading.